So today we now look at our chapter 11. Chapter 11 is called Reporting Methods. Reporting Methods. Ann Karaja, good morning.
Good morning, Walim. How are you?
Fine, thank you.
Good.
So we are looking at chapter 11, what is called Reporting Methods. Reporting Methods. And we write that these are methods used to prepare. These are methods used to prepare income statements. Used to prepare income statements in cost accounting department. In cost accounting department. Full stop. There are three methods. There are three methods. Depending on how they analyze overheads, depending on how they analyze overhead costs, depending on how they analyze overhead costs, and how they value stocks, and how they value stocks. Full stop. The methods are one, absorption costing method. Number two, marginal costing method. And number three, activity-based costing method. Activity-based costing method. Yeah, so how do we prepare the income statement? We have three methods that are used, and the difference is how they analyze the overhead costs and how they get the value of the stocks. We'll be seeing that. So let's start with the first one. Absorption costing method. Absorption costing method. Some people also call it indirect Others call it full cost method. You can call it absorption, you can call it total cost. Indirect full cost or total cost. And we write that this method values stocks. This method values stocks using both fixed and variable production costs. Using both fixed and variable production costs. The general format is as follows. The general format is as follows. Format of an absorption. Costing income statement. The format of an absorption costing income statement. We always begin with sales. They are put here. Sales. Then you say less opening stock. You put it somewhere here. Production costs. You put it here. Closing stock. You put there. You get cost of sales. Cost of sales, you get there. When you get the cost of sales, you get the gross profit. Then you say fixed production overhead costs. We start with absorbed. You put it there. Then you bring the actual. Bring it there. Then you have over or under absorption. Over or under absorption. Now, if it is over, is positive. If it is under, is negative. It's negative. Then you bring non-production costs. Non-production costs, we have the variable. They are brought there. And then we have the fixed, bring them there. And that brings us to the end. You have net profit. You have net profit down there. You have net profit. Maliza copy, let me know. Let's say done. Okay. Let's look at some advantages of the same. Why some could say this method is good. Advantages. Number one, it takes into account all the production costs. It takes into account all the production costs in stock valuation. Takes into account all production costs in stock valuation. Number two, it is suitable for preparation of final accounts. It is suitable for preparation of final accounts. Final accounts, since it is accepted by the accounting standards. Since it is accepted by accounting standards. Number three, It is best for small companies. It is best for small companies since it enables determination of real price and profit. It's best for small companies since it enables determination of real price and profit. Another one is suitable when demand is constant. Suitable when demand is constant. Yeah, I think those points are very direct. There is no need for any emphasis. Let's look at disadvantages. Some of the shortcomings that will be cited. Disadvantages. Advantages. Disadvantages or the limitations. One, not effective in profit monitoring. Not effective in profit monitoring. Not effective in profit monitoring. Since it includes fixed costs. Since it includes fixed costs, which are incurred irrespective of the output level. Which are incurred irrespective of the output level. Number two, it is unsuitable for decision making. It is unsuitable for decision making and planning purposes. It's unsuitable for decision making and planning purposes. Since it includes fixed costs, which are regarded as irrelevant costs. Since it includes fixed costs, which are regarded as irrelevant costs. Number three, it has the potential of making the company's performance. It has the potential of making the company's performance look more desirable. look more desirable. Look more desirable. Number 4, it is unsuitable for cost volume profit analysis. Is unsuitable for cost volume profit analysis. Suitable for cost volume profit analysis. Another one is it creates need for profits to be adjusted. It creates need for profits to be adjusted. For profits to be adjusted for over or under absorption. It creates need for profits to be adjusted for over or under absorption. Yeah. So that is about the disadvantages. And all of them, as you'll be seeing when we handle a question, they stem from the fact that we are using fixed cost. So fixed cost huwa inaharibu hiyo mambo yote. Yeah. It creates the overs, the unders. It's not very good in decision making, CVP analysis, as you'll be seeing when we come to that topic, and so on. So let's look at the next one, marginal. Number 2, marginal costing. Some people call it variable costs. Others call it direct costing method. It has all those names. Marginal costing, variable costs, direct costing methods. Direct costing method, and write that this values stocks using variable production costs only. This values stocks using variable production costs only. Full stop. Fixed production costs is treated as a period cost. Is treated as a period cost. Is treated as a period cost and written off fully. And written off fully. And written off fully in the income statement of the period. In the income statement of the period. Okay, so let's have format of marginal costing income statement. Format of marginal costing income statement. Format of marginal costing income statement. We begin with sales. Naweka hapa. Less opening stock. Let's put here. Production costs. We put it here. Closing stock. Put it there. Get cost of sales. Cost of sales. Put it there. When you put the cost of sales there, the next thing is you get something called gross contribution. Gross contribution. Then you say less variable non-production costs. Variable non-production costs. When you do so, you get a figure called net contribution. Net contribution. Net contribution. Then you say less fixed production costs. Fixed production costs, you put it there. Then fixed non-production costs. Fixed non-production costs. And with that, we have net profit. We have net profit. We have net profit. When you finish, you say yes. Okay. Let's look at advantages. 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 Number one, suitable in decision making. Suitable in decision making. Since it does not include fixed costs. Since it does not include fixed production costs. Since it does not include fixed production costs in stock valuation. In stock valuation. Number two, it enables easy comparison of profits. It enables easy comparison of profits for different periods. Easy comparison of profits for different periods. Easy comparison of profits for different periods. Another one is that it is much easier for determination, or rather for accounting. It is much easier for accounting. It is much easier for accounting and determination of product costs. It is much easier for accounting and determination of product costs. It's much easier for accounting and determination of product costs. Another one is it makes cost control easy. It makes cost control easy. Another one is that suitable for pricing decisions. Suitable for pricing decisions. Suitable for pricing decisions and cost volume profit analysis. And cost volume profit analysis. And cost volume profit analysis. For now, you may not be able to see that clearly, but we have topics, 2 or 3 that are coming, that now you'll see the application of this very, very well. I think that's when these advantages and disadvantages will come out so well. Let's look at some disadvantages. 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 1, it is difficult to accurately separate. It is difficult to accurately separate fixed from variable costs. It is difficult to accurately separate fixed from variable costs. Yeah, that's always a challenge. Number two, it may not enable full recovery of costs. It may not enable full recovery of costs when used in pricing decisions. When used in pricing decisions. When used in pricing decisions. Next, it takes variable cost per unit, variable production cost per unit. It takes variable production cost per unit as fixed. Variable production cost per unit as fixed, irrespective of the activity level. Irrespective of the activity level, irrespective of the activity level, which is not always true. Which is not always true. Yeah, so those are the problems with marginal costing. Those are problems with marginal costing. And I think we now need to switch to the questions. Method number 3, the activity-based. It will be better understood after we have understood these two, because it comes in to solve. It comes in to solve the problems that the two methods have. The two methods have. If there's something else we need to note. Let's just draw down there. Profits reconciliation statement. Profits reconciliation statement. We normally start with the profit per marginal costing. Profit per marginal costing. You less difference in opening stocks. Difference in opening stocks. You add difference in closing stocks, difference in closing stocks. This gives you profit per absorption costing. Profit per absorption costing. Yeah, so once you prepare the two statements, they always report different profits. And the reason is just simply because of the fixed costs. The reason is just because of the fixed costs. So we normally do a reconciliation, just like what you were doing yesterday. We do a reconciliation. And that's the format. This one is much easier. Sasa, let us go to this question that was examined in December 2023. There, December 2023, question number 4. For A. Question number 4A. So if you are there, the question says, Melta Limited has just completed its first year in operation. The unit costs and selling price based on absorption costing basis are as follows. So standard cost and selling price, direct materials, direct labor, production overheads, we have variable overheads, fixed overheads, standard production cost, standard profit margin, standard selling price. Other budgeted costs during the period in relation to selling and distribution and administration were as follows. The selling, we have the variable 10% of sales, fixed the administration. Now, during the year, the company had the following activity level. The actual was that, units sold were that. Actual fixed production overheads were shillings 300,000 less than absorbed fixed production overheads. Budgeted fixed and distribution overheads were 50,000 less than actual. Melter used an expected activity level of 24,000 direct labor hours to compute the predetermined overhead rates required. Prepare the following statements. Yeah, now, anytime you see yourself in marginal and absorption, there are two steps that you should take, or there are two things that you should first of all get. One is called unit cost. You must be able to know what is the cost of one unit. What is the cost of one unit? And we always start with marginal. Actually, I should have said, okay, this hour. We start with marginal. Now, marginal, tumesema marginal uses the variable production costs only. So it will take the 700, it will take the 800. Those are variable production costs. It will also take the 300, the 300 overheads. So those are the variable production costs. So give me the total of that. $1,800. Then fixed overhead absorption rate. This is the fixed overhead cost per unit. In this question, we are given it is 450. And then we have the absorption. So absorption inachukua the marginal, that is the variable, unaongezea the fixed 450. Unaongezea the fixed 450. So when you do so, you get what? $22.50. $22.50. Higher. There is something else that we prepare called stock schedule. Stock schedule. Now the stock schedule normally has this format. Here we have details. And in the details, we start with the opening stock. You add production. you less sales, you get closing stock. You get closing stock. That's the format. So if you have different periods, because there are times you get a question with different periods, sasa unazigawa. But kama you just have one period, you just write units. You just write units. So we are told by information 2. Information 2, production was 24,000. And sales were 21,300. Sales were 21,300. Now, the question has not given us anything to do with stocks. Anything to do with stocks. And we are told that, or before that, if you are not told anything to do with the stocks, we always take opening to be 0. If you're not told anything about stocks, you take the opening to be 0. If you take opening to be 0, if production is more than sales. If production is more than sales, like in our case here, that would be 0. But if production is less than sales, for example, you are told production was 10, but they sold 13. And the question has not mentioned to you about opening stocks. This means they must have had an opening of 3, because you cannot sell more than what you produced. You cannot sell more than what you produced. So it depends on what has been provided. That is, if production is more than sales, you always take opening to be 0. But if production is less than sales, the difference is the opening. For this question, we are further told that this was the first year of operation. So if this was the first year of operation, it means they did not have the opening stock. So tell me now, the closing was how many units? The closing was how many units? Closing is 2,700. Yeah. So these two things must be put in place before you embark on the income statement. The unit cost and the stock schedule. The unit cost and the stock schedule. Once that has been put in place, we now proceed and get the, nataka tuanze na gani? Nataka tuanze na absorption costing. Absorption costing, profit or loss statement. Profit or loss statement. Profit or loss. Statement. So we get sales. So to get sales, you will take the unit sold, that is the 21,300 multiplied by the selling price of 5,000. The unit sold of 21,300 times 5,000. Tell me the answer. Let me get the two answers so that you're able to compare. Yeah, 106,500. Then you say less opening stock. Now, opening stock, we have 0. So there is nothing here. Higher. Production costs. Production costs, you will do like this. Utaenda hapo juu, unit cost tulipata ni 2250. Unit cost tulipata ni 2250 multiplied by the units produced, 24,000. So 2250 times 24,000. That's how you shall get the production cost. $22.50 times 24,000. $54 million. Higher. Then closing stock. You do the same. Our closing stock was 2,700 units. 2,700 units. You multiply by 2250. 2250 times 2,700. $22.50 times 700, $60.75. Now you less that, and when you less, what you get is called cost of sales. Cost of sales. You get cost of sales. 47,925. Haya. With that, you get a figure we said is called gross profit. A figure that we said is called gross profit. It is 58,575. 58,575,000. Then you say fixed production costs. Fixed production costs. Now, in the fixed production costs, you begin with the absorbed. Then you come to the actual. Now, this question is telling us, according to information 3, that actual fixed production overheads was 300,000 less than the absorbed. Was 300,000 less than the absorbed. Now, how do we get the absorbed? How do we get the absorbed? You remember from the topic of overheads, it is the OAR times the actual production. So our OAR ni ile ilikuwa tuliandika fixed overhead absorption rate hapo juu, which was 450. So take 450 multiplied by the actual production of 24,000. 450 times 24,000. That will be the absorbed overheads. 450 times 24,000. $10,800. So hiyo tunaiweka hapa 10,800. Hiyo ndio inaitwa absorbed. Now we are told that the actual was 300 less. So subtract 300. Actually, when you subtract 300, this now comes to 10,500. Now, if it is less, I told you when we were in this topic that this one now is a case of over, and you can even see this is a case of over absorption. Over absorption. Now that over absorption of 300 is written here. And I also taught you that over absorption is treated as a gain. Over absorption is a gain. So that one now we are adding. It comes in here as a positive. It comes in as a positive value. So if it is coming in as a positive value, the next thing that we said we do is to bring non-production costs. Non-production costs. So unazipanga depending on how they are given in the question. So the non-production cost that we can see at the information 1, we have the selling and distribution. Selling and distribution. And this selling and distribution, it is divided into 2. There is the variable. There is the variable. And variable is 10% of sales. So 10%, our sales ni hii. So if you get 10%, it will be 10 million. It will be 10,650,000. It's 10% of sales. So it is 10,650,000. Higher. The fixed. Now the budget fixed, we are told is 9 million, but we are told by information 4. If you look at information 4, budget fixed and selling overheads were 50,000 less than the actual. So here we already use the actual. So if they were less, then kumaanisha we had 8,950,000. No. Budget ndio ilikuwa less. So kama budget ilikuwa less, ni kumaanisha the actual was more. The actual was more, was 90,50. So the actual is 9,050,000. Because you are told the budget was less, so the actual was more. Then we come to the administration. You can see there is a cost of administration. So administration, we do not have the variable, but we have the fixed. So we show it there, the fixed. So the fixed, is 12,300,000. It has not been mentioned anywhere. Now, if it has not been mentioned, you take that the actual is equal to the budget. The actual is equal to the budget. So we are going to have 12 million here, 300,000. You subtract. So when you subtract, that now gives you the net profits. The net profit. That gives you the net profit. I'm waiting. Oh, ama iliyoanza 10800. No. Nafikiria towards here. You are giving different answers. Ann Karaja, I think you have added. You are supposed to say this 58 plus this 300 minus this 3. So confirm 26,875,000. Confirm that is 26,875. Yes. So let's now proceed on and prepare the what? The marginal costing. The marginal costing. The marginal costing. Profit or loss statement. Now with this, again, we begin with sales. Sales remain the same. Sales remain the same. 106,500. 106,500. Sales remain the same. Then you less opening stock. Now opening stock remains the same. It was 0. Then we go to production. Now production costs, we will now value the 24,000 units using the marginal cost. Ile tulikuwa tumepata hapo juu. It was 1,800. Remember the 1,800. So utachukua 1,800 times the 24,000. 1,800 times the 24,000. That is what will be the value of production costs. 1,800 ile tulikuwa tumepata huko juu as unit cost at the marginal times the units produced 24,000. 43,200,000. So inaandikwa hapa 43,200,000. Then we have the closing stock. Now closing stock, you will take the 1,800 times the units of closing stock, which were 2,700. So 1,800 times 2,700. 1800 times 2700. $48.60. So you less that, and when you less, you get the cost of sales. $38,340. So we bring it here. Now that one, when you less, we get a figure called gross contribution. Gross contribution. $68,160. $68,160. Then you less variable non-production costs. So variable non-production costs, we had selling and distribution. Selling and distribution. Now this selling and distribution, the variable, just like we computed at the absorption, it is 10,650. That way. And when you do that, you get the figure we said is called net contribution. Net contribution. Net contribution. Net contribution. $57,510. $57,510,000. Then you less fixed costs. And the fixed cost that you less, you begin with production. Now production, ile actual that we had in marginal. The actual yenye tulikuwa nayo kwa marginal, not kwa marginal, kwa absorption. Kwa absorption, it was 10,500. The fixed production. Then there was selling and distribution. Selling and distribution. Selling and distribution. Now, selling and distribution, the same way we had it, at absorption, it is 9,050,000. $9,050,000. Then we had administration. Administration is 12,300. 12,300. So with that, we have net profit. $25,660. Now, if you can understand that format, this one for the marginal and this one for the absorption, you are good to handle any question in this area. You are good to handle. That's the way they are. You can cram that format. The only difference you can get is when they give you for different periods. Unaambiwa maybe kuna year 1, year 2. Yeah. Unaambiwa kuna January na February. That's the only difference. But now for each period, unategeneza hivi. Yeah. So the last thing that remains is now to do the reconciliation. The reconciliation. Let's design the reconciliation statements. Reconciliation statements. Profit reconciliation statement. Profit reconciliation statement. So the profit reconciliation statement, tulisema, you start with the profit per marginal costing. Per marginal costing. Now the profit per marginal costing ndio hii 25,660,000. The profit per marginal costing. Then we said you less difference in opening stocks. And you realize that the opening stocks in both statements were zeros. The opening stocks in absorption ilikuwa zero, na kwa marginal ni zero. So there is no difference. Then you add difference in closing stocks. So to get this, you realize that hawa walitumia 4860 na watu wa absorption wakatumia 6075. So give me the difference between the two. The difference between this 6075 na hii 4860. $12.15. So naiweka hapa 12.15. When you do that, you get now profit per absorption costing. Profit per absorption costing, which you had gotten here as 26,875,000. And you can confirm that they are agreeing that if you take this, you less zero, you add this, it goes back. That's how we do the reconciliation for the marginal. And I said, ukiulizwa why we have a difference, why these two are different, it is because we have the fixed costs in stock valuation. Actually, they say, if you want to get the difference, the difference in profits, if you want to get the difference in profits, you get the opening stock, you less the closing stock, you multiply by fixed overhead absorption rates. If you want to know the difference between the profits, now our opening stock was 0 and the closing stock was 2,700. I guess so. I think that was the case. And the FO young was 450. Hebu multiply hiyo. You want to know the difference in profits. Yeah. 1215. Yeah. So ndio hii, sinaona the difference between this and this is this. Yeah. But kama tungekuwa na value ya opening, kama tungekuwa na value ya opening, you would still see the same. Ungeweka the opening stock minus the closing, you multiply by this. It will give you the difference between this profit, this one and this one. Good. If you are okay, sema yes. If you are not okay, uliza swali. Yes, Anne. Yes, Jemima. Now, if we are okay, I would like you now to handle on your own this question of May 2011, question 4. May 2011, question 4. May 2011, question 4 is exactly like this one. And I keep on telling you, if you want to handle the question well, kwanza unajibu hii, you solve this one that we have solved together. Unafunga kitabu, unajaribu kusolve hii kwanza mwanzo mpaka mwisho. The moment you have gotten it right, now you can go to the assignment. So that brings us to the end of our lesson today. When we meet tomorrow, God willing, we now discuss the activity-based costing. So tomorrow we meet at 5 or at 4. What do you want? Anne says 4. So Jemima. Okay. So then let's meet at 4 again, so that by 6 tukuwe tumemaliza. Yeah. Thank you very much. See you tomorrow.